Thank you to my Patreon supporters. A double shout out thank you to Xavier Zamora, Victor, Velimir Brakovich, Troy Smothers, Safe Munaz, and Murad Shaker for being higher level patrons. We are 4 patrons away from hitting 50. If you guys would like to join that for as little as $1 a month, there is a link down in the description. Also, thank you to my YouTube members. You can click the join button down below if you'd like to join that. Please keep in mind, I am not a financial advisor. This is not financial advice. Everything I'm sharing is my own opinion. It's my own research. I highly encourage you to go do your own research. And with that being said, let's go ahead and get into the news. This article is a little bit older, and I've actually had it on the side, and then I realized, and I was like, you know what? This actually, I think, could have a direct tie with SafeMoon, because I read through it more, and I was like, you know what? Okay, so I need to make a video talking about this. So this is an article from Forbes. I'll provide a link in the description so you can go check out the article for yourself. And it's titled, "In Huge Precedent, IRS Refunds Income Taxed on Unsold Staked Crypto." This has to do with the SafeMoon reflections, by the way, so don't go anywhere. In court filings expected to be made public Thursday, the IRS declared it would refund $3,293 in income tax plus statutory interest to a Nashville couple who had paid the amount on 8,876 Tezos tokens they had obtained through staking. According to a May 2021 civil lawsuit filed by the couple, Joshua and Jessica Jarrett, any tokens gained through proof of stake should be considered new property created by the taxpayer, and therefore not income which comes in to the taxpayer. In order to be taxed, tokens gained through staking, this is key here, or any other newly created property, i.e. I'm looking at reflections, tokenomics, that's what I'm trying to get at, must be first converted into a readily accessible form of wealth. So the readily accessible form of wealth, yeah, that's kind of a broad thing. I think that's what it's trying to hint towards is getting back to fiat. So you're going off of a decentralized exchange, you're on a centralized exchange, and then you're saying, hey, I want to actually convert this to the bank. And to do so, you're doing a fiat off-ramp. And what happens when you do a lot of your investments, right? It's still in its own format. Now, technically, when you do a trade, that is supposed to be a taxable-based event, right? So if you're trading from one crypto to another, they look at that and they say, oh, it's a taxable-based event. You got to report capital gains in that sense. But with this, you're accruing it on top of a balance, but you haven't actually proactively traded it into anything. So the staking mechanism is very interesting, and the reward system, I feel, fits in with the other newly created property kind of mechanic. So this says, thus the lawsuit claims until the tokens are sold, no taxable event has occurred. Actually, now that I think about it more, I think this does tie in with a lot of these passive income cryptos too. So if you're dealing with projects that have nodes or give you consistent ROI, those kinds of things, it very well could play in the same regard. So examples of that would be reflectionary tokens. Let's say MetaBUSD, that gives you BUSD rewards. Evergrow gives you BUSD rewards. Crypto token, I've talked about all these things, give you BUSD rewards. Affinity, they have a staking mechanism. You can go in with them. That gives you Cardano and BUSD rewards. Passive income plays with the nodes. So like Strongblock, for example, Strongblock, if you go and you do that, you get consistently a certain amount of strong per day. Drip, you get a consistent amount of drip per day. And there's other tokens that are out there that are kind of doing these similar things. So all of that, including the cryptos that do tokenomics, right? So SafeMoon, Hoj Finance, the list goes on. Thus, the lawsuit claims until the tokens are sold, no taxable event has occurred. The decision sets a large precedent amid a broader policy debate on how to define and tax crypto assets. The 2021 version of IRS Form 1040 prominently features a line item asking if filers at any time during the year, quote, received, sold, exchanged, or otherwise disposed of any financial interest in any virtual currency, indicating to many the IRS intends to make crypto a central point of focus moving forward. However, there still remains confusion as IRS instructions issued as recently as December 21st defined a transaction involving virtual currency as one that included the receipt of new virtual currency as a result of mining and staking activities, going directly against the decision at hand. I'll say that part again. They defined a transaction involving virtual currency as one that included, quote, the receipt of new virtual currency as a result of mining and staking activities, end quote, going directly against the decision at hand. With tax filing season for 2021 opening last week, the news has already created large waves in the crypto community. While it's unclear at the moment if the IRS plans to update its official guidance for last year, sources close to the matter say the couple plans to pursue the case further in court to obtain longer-term protection. This would undoubtedly set a national precedent for the growing staking industry, currently estimated to be around $18 billion. One thing's for sure, with half of all Bitcoin owners filing taxes on the crypto for the first time this year, the decision is likely to be one of the most closely watched of the 2021 tax filing season. So this is going to be very interesting to look and see how this continues to develop further, because lo and behold, guys, if it ends up being that, hey, they're okay because of how they're staking things on a long-term perspective and how that's being handled, that could change this whole game. It could change how we handle our investments, because a lot of people will make decisions in preparation to what's coming up with the tax season. Something else that's quite interesting is that since then, another article has been published by Forbes, and it goes on a little bit more details about this. So Jarrett, the individual I just mentioned here a little bit ago, Jarrett, the president and CEO of Quantify Fitness, a gym in Nashville, Tennessee, released a statement indicating he would not accept the refund from the IRS, which was at the beginning of the article I just referenced in the earlier part of this video, but rather continue on in the trial to help get an explanation along with his money back. For Jarrett, part of his complaint is a result of a lack of guidance from the IRS on how to treat cryptocurrencies that are received from blockchain networks in return for their efforts to validate transactions and create the next block on a blockchain. On the court documents, 6 attorneys from 2 separate law firms are listed that include J. Abrams Sutherland, who has been making a name for himself in cryptocurrency circles recently and also serves as an advisor to the Proof of Stake Alliance and as an adjunct professor to the University of Virginia School of Law. Leading the negotiations for the case with the DOJ is David L. Forrest, a tax partner at Fenwick & West LLP. Fenwick represented Coinbase in its direct listing of Coin on the NASDAQ, which after the first day of trading was valued at $85 billion, and even has a testimonial from Paul Grewal, chief legal officer of Coinbase, about how helpful the firm was in understanding the new technologies like cryptocurrency. I really want to stress for everyone just the level of importance of a case like this is. For them, the individuals, it's a couple $1,000s that they could have got back on their tax crypto, right? But for the rest of us, this could change the entire industry as a whole, and we're having potentially billions of dollars in play here. And right now, things are actually looking much more favorable for us in the cryptocurrency industry space rather than just having it be straight up taxed just because. So I'm going to go ahead and read from another article here. I don't want this video to get too long, but let's go ahead and get into this. This says, as his lawyers put it, like a baker who bakes a cake using ingredients in an oven or a writer who writes a book using Microsoft Word and a computer, Mr. Jarrett will realize taxable income only when he first sells or exchanges the new property he created. On the other hand, the IRS likely believes that tokens obtained through staking should be treated the same as tokens mined via proof of work, as taxable income akin to a payment received in exchange for validating transactions on the blockchain. This dispute forms the basis of the lawsuit Jarrett filed in 2021, seeking a $3,793 refund from the IRS. Throughout the case so far, surprisingly, the Justice Department lawyers tasked with defending the IRS have had some difficulty articulating its basis for taxing Jarrett's tokens. In its August 2021 answer to the complaint, the government denied that virtual currency is in all instances property for purposes of U.S. tax law. That denial raised eyebrows among many observers, particularly given its apparent contradiction of the IRS's own 2014 guidance. The government has not since articulated the circumstances in which it views virtual currency as property received for the performance of services. In general, this would be a beneficial answer for the crypto community because the value of the tokens received is likely to be small when received. When the tokens are then later sold or exchanged, future gains could be treated as long-term capital gains. In other words, it's better to have a small amount of ordinary income today and significant amount of long-term capital gains in the future. Hoping to avoid an adverse decision that might limit its ability to tax staking activities as full ordinary income transactions in the future, the IRS recently offered to refund Jarrett the full amount of his claim in exchange for dismissing the case. On February 3, 2022, however, Jarrett announced that he was turning down the IRS's offer and would seek a final court decision instead. Until the case receives an official ruling from a court, there will be nothing to prevent the IRS from challenging me again on this issue. Jarrett said in his statement, I need a better answer. I think that's very valid. I would love to know what you guys think on this, so be sure to tell us your thoughts in the comments down below. Quick side note, I am an NFT artist. I have a piece that is up for sale. The link is in the description. You can buy it for 1 million SafeMoon, or you can buy it for 10 BNB, but the price is obviously more feasible if you do for the 1 million SafeMoon. I have referral links in the description if you want to get free crypto, free stock. If you guys are new, do not forget to hit subscribe. Hit the thumbs up like button. It definitely helps us out with the YouTube search algorithm. Click the bell icon so you know whenever we go live. God bless, and I will see you in the next episode.